the disaster did not happen. Last week, the financial world was focused on several important events: the quarterly reports of Apple and Amazon, and the labor market report. Obviously, the state of the labor market affects the Fed's decisions, and the corporate results of giants whose total capitalization exceeds the GDP of some G7 countries reflect the real sector of the economy in many countries. But unexpectedly, these two events were joined by another, and not very pleasant one. Hi, this is a quick review from Evan Compan, Edinburgh Business School analyst.
Fitch downgraded the U.S. credit rating from AAA to AA+. Among the main reasons for the credit agency's decision are the political struggle over the debt ceiling, the growing budget deficit, the growing volume of debt, and the central bank's rate hikes. The U.S. Treasury Department and the White House were very unhappy and assured the Fitch's decision did not reflect the real achievements of the current administration in strengthening the economy. But in general, no catastrophe seems to have occurred, and the current events should not even be compared to the violent effect that a similar decision by S&P in 2011 caused, when the situation on the markets and in the economy was much worse than now.
Speaking of the economy, Bank of America had previously predicted a moderate recession in 2024, but changed its views in favor of the U.S. economy's growth. Also, the GDPNow model estimates GDP growth in Q3 at 3.9%, although a few days ago it was 3.5%. So, the macroeconomic indicators are not so bad, although the likelihood that we may see inflation rise again in the near future is quite high.
The July labor market report showed that the number of new jobs increased by 187,000 in the month, slightly higher than in June, but less than the expected 100,000. At the same time, average hourly earnings increased by 0.4%, the same as last month, and slightly higher than the 0.3% forecast. The economy is holding up, wages are growing, and the issue of price increases remains open.
Apple and Amazon reported mixed quarterly results. The retail giant exceeded analysts' expectations, especially in the cloud business segment, and gave an optimistic outlook for the next quarter, for which it was rewarded with a rise in its share price. Apple, although it exceeded its revenue and profit forecasts, was disappointed by the decline in sales of iPhones, Macs, and iPads. But, in general, the results of the companies that have already reported for the second quarter are quite decent and, despite expectations, no catastrophe has occurred.
The tech sector is full of optimism about advanced artificial intelligence technologies, online advertising, and the growth of cloud services, and continues to pull the entire market up. It seems that hopes for a fantastic effect from the use of AI are currently compensating investors for all the disappointments from the modest current results.
And finally, we would like to remind you that the information you have just listened to is not an investment advisory. Remember, investments in the stock market are always tied up with financial risks. So be careful and cautious. Like and subscribe to our YouTube channel. See you soon.